Ladies and gentlemen, good day. Myself Arun Lal from TrustLine, and welcome to TrustLine Holdings webinar. As a reminder, all participant line will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Please note that this webinar is being recorded. I welcome Mr. Govind, Business Development Head, to give a brief introduction about TrustLine, and Mr. Arunagiri, who is the founder, CEO, and CIO. Over to you, Mr. Govind.
Thank you, Arunlal. Good evening, everyone. We thank you for your time today to attend our webinar. Our markets have been struggling to break out for better part of this year. They have got stuck in a sideways limbo. Why mood is negative when the math is turning positive is the central theme of today's webinar. We hope you will find the session quite interesting as well as informative. Before that, we take a few moments to introduce our company, TrustLine Holdings, and the speaker for today's session to the participants. TrustLine is a 2-decade-old SEBI-registered alternate asset management company. We are a small cap specialist and a meticulous practitioner of value investing. Our asset under management currently stands around 1100 crores. We have built an enviable client base of C-level leaders who form the majority of our 600 plus clients. Today's session is going to be anchored by Mr. Arunagiri, who is the founder, CEO, and Chief Investment Officer of TrustLine. Arun comes with more than 2 decades of small cap investing experience. The session will last around approximately 45 minutes, with 15 minutes being allocated for Q&A. Over to you, Arun.
Thank you, Govind, for keeping the introduction very brief and short. Good evening, everyone. It's my pleasure to be the speaker for this session. Welcome once again, all of you, to this webinar. Without taking too much of a time, let me straight away get into my topic by sharing some staggering and some shocking data points. Exceptional and I would say exceptional things have unfolded in the markets for the last few months, which has led to these shocking data points. Let me explain. Shock number one: dramatic fall in our currency rupee. If you look at the absolute number, I think rupee has fallen by about 4.5% against dollar. And that doesn't tell you the full story, because this year, calendar year, dollar has fallen by near 10%, which means most of the other currencies have appreciated against dollar. So rupee has fallen much worse if you compare it with other currencies. For example, if we take euro as an example, rupee has fallen by over 17% this calendar year. That is shock number one. Coming to the next shock, massive FII sell-off in the Indian equity market. If you look at the headline number, it will tell you that 20 billion, 19 or $20 billion have been sold by FPIs this calendar year. But that doesn't again give you the full picture. If you adjust for the purchases by FIs in the primary market of about $7 billion, the total sale in the secondary market comes to about $26 billion. This coming on top of another $11 billion selling in October, November of 2024 makes it about $38 billion in just 14-15 months. That's massive. And Indian market has not witnessed such a massive sell-off for a very, very long time. I think for the first time, probably we are witnessing such a massive sell number on FPIs. That's shock number two. Shock number three: terrible underperformance of Nifty and Sensex against global markets. Of course, if you look at in absolute terms in India, in isolation, Nifty has done close to about 9% this year, calendar year. If you adjust for the rupee fall, and in terms of dollar returns, it has done probably low single digits. Again, that doesn't give you the full picture. When you look at the other markets, emerging market as well as developed markets, most of them have done much, much higher at about 20% plus, 25% plus returns. Just for example, Korea has done 70% plus dollar returns this year. So there has been a terrible underperformance by Nifty. Again, if you look at Nifty and Sensex, the aggregate indices may be just about 1 or 2% off from the highs. That may be completely misleading picture. If you dig down and go into the market cap spectrum, the broader space has witnessed a huge bloodbath. In my view, I may not be even, I may not be wrong if I tell you that 50% of the stocks in the broader space have fallen by 40, 50% in this year. Almost we are back in most of the stocks to 22, 23 levels. So that's the kind of fall this market is, witnessed. That is shock number 3. Shock number 4 is a weak bond market. That is at a time when RBI is pumping liquidity month after month and has cut interest rates, 125 bips cut in the interest rate since Feb 2025. And also, you should not forget there was a CRR cut. In spite of all that, if you look at the 10-year bond yield, it's back to where it started when the RBI started cutting rates in February 2025. So we are almost, a couple of days back, it was at 6.7. Now slowly retracing back to 6.6 and all that. This is partly again due to huge fall in rupee as well as FPI selling in the bond market. So we have discussed these shocking things. Now, why are we saying that these are shocking data points? This kind of dislocation happens normally when there is a macro crisis. Are we witnessing any macro crisis in India? Something like 2013, when there was a policy paralysis, rupee was on a free fall. Or go back to 2008, during the global financial crisis, there was a huge macro issues. You had all these data points which were moving down. Or take 2020, which is a COVID year. So those kind of crises, you can see dislocation. Currently, the macro, if not anything, it is pristine. It is in pink of its health. You look at fiscal deficit, you look at current account deficit, you look at forex reserves by RBI, you look at the monetary policy, you look at inflation outlook, all-time lows, and you look at interest rate, we are on the rate cutting cycle. So in this kind of situation, why there is a dislocation? Why, what exactly is happening to the market? Why the sentiment is so disconnected from the fundamentals? If at all, not only the macro is good, if at all you are seeing a lot more improvement on many, many factors. Let me give you some of the pointers in terms of where we are seeing significant improvement. The first one is normalization of valuation. Like, for example, if you look at the peak of 2024, September 2024, Nifty was trading at about 27 times 1 year forward. And small mid caps were trading at around 33, 34 times 1 year forward. That was the case. And that valuation was at a huge premium to historic multiples. Last 1 year, the markets have spent kind of time correction and the earnings have moved up marginally. As a result, the 1 year forward valuation multiple has come down all the way to 1920, which is at our at our historic averages. It's not at a huge premium, so it has come back to our historic averages. So valuation comfort has come back. And the second factor which is more interesting is there is a visible acceleration in the reforms momentum by this government. One might argue that it is being pushed to do these aggressive reforms because of delay in US-India bilateral trade. That could be a point, but the absolute fact is that the government is on a kind of an accelerated pedal when it comes to reforms. It started with GST 2.0 reforms. Now, as we speak, we have about five bills which is on the reform direction, which some of them have been cleared by the parliament. And most of them have been cleared by the cabinet, and some of them are in the pipeline for next session. Be it your 100% FDI in insurance, opening up nuclear power sector to private sector, and the reforms on the coal exports, reforms on the oil and gas exploration. And not to forget that the number of free trade agreements the government is aggressively pushing with various countries. So there is a visible improvement on the reform direction. And as we head to the budget, in our view, I think this budget is going to be very, very reform oriented. You will see, unlike other budgets, there will be a lot of measures which will be very positive for the economy as well as for the markets. And the third positive factor is the earnings recovery. Last year, we had gone into kind of a slowdown in earnings. There is a visible improvement in the earnings in the second half of FY26. But as we get into FY27, the consensus view is that earnings will get into double-digit acceleration. So when all these positives are there, why is there a disconnect? Why is this divide? Why is mood overtaking the math? That is the main theme of this webinar. Now, to understand this, I think we need to step back and look at the context of how this market has evolved since the last peak in September 2024. And that will give a perspective of what is actually happening as we are at end of this calendar year. Sometime in the second quarter of FY 2024, the economy started slowing down. Partly as a result of the election by which the government started putting the brakes on capital expenditure. Also partly because of heavy monsoon rains. Coupled with tight liquidity at that point of time, the economy got into a slowdown. We would probably term this as a mid-cycle slowdown, not a very structural slowdown, kind of a cyclical mid-cycle slowdown. Now the markets, despite the signals from the economy, it kept going up till September end. But when the September quarter results started pouring in, kind of a reality check happened for the market. FIIs started panicking. And that's when October, November numbers, if you look at $11-12 billion, just like that disappeared on those 2 months. And this coming on the back of an extremely high valuation, as I said, 27, 28 times 1 year forward for Nifty and the broader market at 33, 34 times. They press a panic, FIs press the panic button and they started pulling out money. And the market, of course, somehow it held up thanks to the domestic SIP flows and domestic mutual funds. But that, holding up didn't last long. Coming into 2025, early 2025 with Trump's tariff tantrums, the market couldn't held on to this, levels and then it started cracking. But after that, I think the market kind of stabilized. It was in a sideways setup. It was going nowhere. It was not able to break out. Broader market, there was some stock-specific action. So it was kind of nowhere, stuck in a sideways, going through a time correction kind of a market till the end of October. But as we moved into the last quarter, 2025, the panic started. Primarily because of the Gen AI trade consuming the whole global markets. Since India didn't have an AI story and India didn't present any opportunities for FIs who were looking for kind of AI proxy, money started again, next leg of movement, money shifting from India to other markets where AI story was prominent. For example, Korea was up 70% primarily thanks to that. Next to US, you had Korea, Japan, and China presenting, and Taiwan presenting AI kind of proxies. So money started moving, and as a result, FIs selling turned into kind of relentless selling. That kind of led to a chain reaction, which had a rub-off on the rupee. Rupee fell, and the panic started, kind of vicious cycle. Now, when that kind of a thing happens, fear basically the market was gripped by the fear. When fear comes in, the rationality goes, the objectivity goes, and everything falls. In spite of good macro, in spite of good fundamentals, in spite of visibility of earnings recovery, in spite of reforms momentum, all these are getting ignored because of that panic and fear. Now, that's where we are today. Now, the interesting question is, coming into 2026 calendar year. Will this reverse? Will math overtake mood? Or will mood continue to weigh on the math? So this is what is going to be interesting here for 2026. Just to answer that, I think in addition to the positive factors, the comfort factors, which we discussed already in terms of valuation comfort, also in terms of earnings recovery, there are a couple of more points which I would like to highlight, which are very constructive for the markets going into 2026. So there's a talk on AI bubble. So I'm not an expert on AI bubble, so I don't want to, my expertise is not on that. At the same time, our view is that the incremental money flow into AI trade will cool off getting into 2026. Very likely that it will cool off. And so as a result, that cool off in AI trade will become very positive for India because India is seen as a diversification theme for AI. So for the money was shifting all over the place for AI proxies. For some reason, if the AI trade cools off, which is our view, which is what we expect in 2026, it's not going to burst. It may burst, it may not burst, we don't know. But definitely incremental money flow into AI trade will cool down. As a result, that will turn positive for India. Second point, which is critical, is the peaking of rupee depreciating cycle. Rupee has gone and broken 91, and now it's slowly retracing back. It's around, sub 90 levels. And the reason why we are saying it is probably has peaked is going by the REER relative valuation of rupee. Normally, this REER index is around 102 to 103 is what is the valuation at which rupee trades. Now at 98 level, it is hugely undervalued. And 1 year back, it was around 108, which was, of course, overvalued. So 198 to 102 is something we expect, which means there could be a retrace of about 2 to 3% on rupee. Now, when rupee, normalizes, that's likely to give incentive for FIs to come back because they would like to capture the upside from rupee as well. They would like to capture the upside from currency as well. Third, of course, is by March, one is expecting this US trade deal, bilateral trade deal is to come through. One is not very sure whether it will come through, but at this point in time, there is a positive view on that by March, I think there will be some settlement. That will be an added positive. So with all these, I think 2026 is looking interesting and there is a constructive view on the market for 2026. Now, the question is whether it is going to be like a one-way momentum for the market, which we witnessed in 2024, or it is going to be like a stock-specific bottom-up market like 2025. It is difficult to say, but given the visibility of FIs coming back, now they have sold about $38 billion in 15 months. Of course, they'll come back, and that when they come back and add that with domestic flows, which has been steady and which has been very resilient, which has not dropped off. So when there is a combo effect of domestic flows and FI flows in 2026, you could see momentum coming back. Whether this momentum is going to be as strong as 2024, very unlikely. In our view, I think 2026 will be a blend of value and momentum, and there will be a lot of opportunities in the broader space for stock pickers. And the way to create alpha in 2026 is to have a mix of momentum and value and ride this, bull phase, which is likely to come in 2026. And in terms of investment landscape and opportunity landscape, there are many stocks across the spectrum. As I said, in the broader space, stocks, 50% of the stocks are down by 40-50%. So you can imagine that the kind of opportunities the broader space is throwing up. So it is for the pickers to choose. There are many opportunities across the spectrum, across the sector. So I don't want to pick any particular sector here. Across the sectors for stock pickers, there are many opportunities visible, and 2026 will be a very exciting and interesting year. With this, let me conclude my presentation. Thanks once again for the participation. Merry Christmas and advanced Happy New Year wishes to all of our viewers. Thanks a lot.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.